In a world where corporate job seems too stressful and freelancing feels too clueless, people often look at businesses and startups as the ideal middle ground, offering more money, freedom, and a sense of purpose. Everyone these days seems to have the zeal and enthusiasm to build something of their own. Starting a new business is exciting but risky. About 20% of new businesses fail in their first year, and roughly half close within 5 years. You are listening to Questica 1, where we take one step towards clarity. I am your host Dhruvi, and today we will try to understand one critical question: why do businesses fail? One major reason could be the poor money management. Theoretically speaking, entrepreneurs might assume that spending more will guarantee growth. They believe that if enough money is pumped into branding, offices, hiring, and marketing, success will automatically follow. But practically, reckless spending and ignoring return on investment can quickly drain a business's cash. Another significant reason for a business's downfall is financial mismanagement. It often works quietly, unnoticed at first, but can destroy the foundation of a business over time. Having the investor's money can feel like a safety net for a business. It gives the founders the confidence to move fast, but without financial discipline, that safety net can become a trap. If budgets are unclear, if money is spent without tracking outcomes, or if costs are added without verifying their necessity, the business may not survive for long. Pouring cash into a company without structured financial plan can lead to serious trouble. Another common trap for the business's failure is rapid expansion. The idea of expanding a business quickly, reaching new markets, hiring large teams, and opening new branches can be tempting. But when done without practical planning, it can backfire on the business. Research suggests that when businesses expand too fast without proper checks, the financial drain can sink the whole enterprise. If revenue isn't able to support those new costs, such as salaries, logistics, or infrastructure, then cash flow gaps emerge. Once that gap widens, it becomes difficult to recover. Another blind spot that many fail to consider is ROI, the return on investment. Often founders may move forward with big ideas, assuming that the customer interest will automatically follow. But testing the core idea in the market becomes important. And the assumption that customers will automatically come becomes wrong. One study even pointed out that many startups neglect to look before they leap. They move forward based on assumptions, not evidence. When the ROI goals aren't met, when the money spent doesn't bring in the expected value, the business begins to suffer. This spending-first mindset is especially common in fast-growing business cultures. In these environments, funding often flows freely and growth is expected to be rapid. Founders even believe that having more money will solve every challenge. But according to researchers, too much funding can actually hide deeper problems. It gives a false sense of security and delays critical evaluation. More cash doesn't always mean fewer problems. Without the pressure of limited resources, some businesses avoid confronting their weaknesses. Instead of solving those issues early in time, they keep moving forward. And eventually, when the funding runs out, the problems that were once hidden can come back even stronger. These are some of the reasons why businesses might fail, even with substantial investment. Financial mismanagement, rapid expansion without planning, and failing to track ROI are all contributing factors. You were listening to Questica 1. Until next time, stay curious and stay sharp.